Navigating a volatile market can be challenging, but with the right strategies, investors can manage risks effectively and protect their investments. Here's how to approach risk management during uncertain times. Understanding market volatility. Defining market volatility. Market volatility refers to the fluctuations in the prices of securities over a period. High volatility indicates large price swings, while low volatility reflects smaller, more stable changes. Understanding volatility helps investors gauge the level of risk in the market and adjust their strategies accordingly. Causes of volatility. Various factors can drive market volatility, including economic data releases, geopolitical events, changes in interest rates, and corporate earnings reports. Keeping track of these factors helps investors anticipate potential market movements and prepare for possible impacts on their portfolios. Diversification, a key strategy. Spreading investments across asset classes. Diversification involves spreading investments across different asset classes such as stocks, bonds, real estate, and commodities. This reduces the impact of poor performance in any single asset class on the overall portfolio. A well-diversified portfolio can help balance risks and smooth out returns over time. Geographic and sectoral diversification. In addition to diversifying across asset classes, consider diversifying geographically and across sectors. Investing in international markets and various industries can further reduce risk. Different regions and sectors often react differently to economic and market events, providing additional stability to the portfolio. Adopting a long-term perspective. Avoiding short-term reactions. During periods of high volatility, it can be tempting to make impulsive decisions based on short-term market movements. However, staying focused on long-term goals helps avoid costly mistakes. Maintaining a long-term perspective allows investors to ride out market fluctuations and benefit from long-term growth trends. Setting realistic goals. Establish clear investment goals and timelines. Having well-defined objectives helps maintain discipline and resist the urge to make knee-jerk reactions to market volatility. Regularly review and adjust goals as needed to stay aligned with changing market conditions and personal circumstances. Utilizing risk management tools. Stop-loss orders. Stop-loss orders automatically sell a security when its price falls to a predetermined level. This tool helps limit potential losses by triggering a sale before further declines occur. Setting appropriate stop-loss levels based on risk tolerance and market conditions can help protect the portfolio from significant losses. Hedging strategies. Hedging involves using financial instruments such as options, futures, or inverse exchange traded funds, ETFs, to offset potential losses in the portfolio. While hedging can provide protection, it may also involve additional costs and complexities. Assess the suitability of hedging strategies based on individual investment goals and risk tolerance. Asset allocation adjustments. Adjusting asset allocation based on changing market conditions can help manage risk. For example, shifting to more defensive assets like bonds or cash during periods of high volatility can reduce exposure to market fluctuations. Regularly review and rebalance the portfolio to maintain alignment with investment objectives and risk tolerance. Maintaining liquidity. Keeping cash reserves. Maintaining a portion of the portfolio in cash or cash equivalents provides liquidity to take advantage of investment opportunities and manage unforeseen expenses. Adequate cash reserves also allow investors to avoid selling investments at a loss during market downturns. Evaluating cash flow needs. Assess short-term and long-term cash flow needs to ensure sufficient liquidity. Having a clear understanding of cash requirements helps avoid forced liquidation of investments in adverse market conditions. Plan for potential financial needs and adjust the portfolio accordingly to maintain liquidity. Monitoring and adapting strategies. Regular portfolio review. Regularly review the portfolio to assess performance, risk levels, and alignment with investment goals. This allows investors to make informed adjustments based on changing market conditions. Periodic reviews help identify any necessary rebalancing or strategic changes to manage risks effectively. Staying informed. Keep abreast of market trends, economic indicators, and geopolitical developments that may impact the investment landscape. Staying informed helps make timely and well-informed decisions. Utilize financial news sources, research reports, and professional advice to stay updated on relevant information. Building a resilient investment portfolio. Creating a resilient investment portfolio is essential for weathering market volatility and achieving long-term financial goals. Here's how to build and maintain a portfolio that can withstand various market conditions. Assessing your risk tolerance. Understanding personal risk tolerance. Risk tolerance is the level of risk an investor is comfortable taking based on their financial situation, investment goals, and time horizon. Understanding this helps in selecting appropriate investments. Factors influencing risk tolerance include age, income stability, investment experience, and financial obligations. Conducting risk assessments. Use risk assessment tools and questionnaires provided by financial advisors or investment platforms to gauge your risk tolerance. Regularly review and update your risk profile as your financial situation and goals evolve. Constructing a diversified portfolio. Selecting asset classes. Choose a mix of asset classes such as equities, bonds, real estate, and cash to diversify the portfolio. Each asset class has unique risk and return characteristics. Equities generally offer higher returns but come with higher risk, while bonds provide stability but lower returns. Incorporating alternative investments. Consider adding alternative investments like commodities, private equity, or hedge funds to further diversify the portfolio. Alternative investments can provide additional returns and help reduce correlation with traditional asset classes. Strategic allocation and rebalancing. Determining asset allocation. Asset allocation involves deciding the percentage of the portfolio to invest in different asset classes. A well-balanced allocation aligns with your risk tolerance and investment goals. Use models such as the 60-40 rule, 60% equities and 40% bonds, or customize based on your individual preferences and financial objectives. Rebalancing the portfolio. Rebalancing involves adjusting the portfolio to maintain the desired asset allocation. This may involve selling overperforming assets and buying underperforming ones. Regular rebalancing ensures the portfolio remains aligned with your risk tolerance and long-term goals. Using risk management strategies. Implementing stop-loss orders. Use stop-loss orders to automatically sell investments if they fall below a certain price. This helps limit potential losses and manage risk. Set stop-loss levels based on your risk tolerance and investment strategy. Hedging against market risks. Employ hedging strategies, such as options or futures contracts, to protect against potential losses. Hedging can provide a safety net during market downturns. Evaluate the costs and benefits of hedging strategies to determine their suitability for your portfolio. Evaluating investment performance. Monitoring performance metrics. Track key performance metrics such as returns, volatility, and risk-adjusted returns to evaluate the performance of your investments. Compare the portfolio's performance against benchmarks or indices to assess relative performance. Adjusting strategies as needed, review investment performance regularly and make adjustments as necessary based on changes in market conditions or personal financial goals. Adjust asset allocation, rebalance the portfolio, or incorporate new investments to maintain resilience. Seeking professional advice. Consulting financial advisors, work with financial advisors or investment professionals to receive expert guidance on building and managing a resilient portfolio. Advisors can provide personalized recommendations based on your financial situation and investment goals. Utilizing robo-advisors. Consider using robo-advisors, which use algorithms to create and manage diversified portfolios based on your risk tolerance and goals. Robo-advisors offer a cost-effective alternative to traditional financial advisors. Understanding market trends and their impact on your investments. Understanding market trends is crucial for making informed investment decisions. By analyzing these trends, investors can better anticipate market movements and adjust their strategies accordingly. Identifying market trends. Types of market trends: uptrends, characterized by rising prices and generally positive economic conditions. Investors often look for opportunities to buy during uptrends. Downtrends, marked by falling prices and potentially negative economic indicators. During downtrends, investors may consider reducing exposure to riskier assets. Sideways trends, prices fluctuate within a range, indicating market indecision. In sideways trends, it's important to focus on fundamental analysis and look for signals of future breakout trends. Using technical analysis, chart patterns, analyze chart patterns like head and shoulders, flags, and triangles to identify potential trend reversals or continuations. Technical indicators, utilize indicators such as moving averages, relative strength index, RSI, and Bollinger Bands to gauge market momentum and potential entry or exit points. Analyzing economic indicators. Economic reports and data, GDP growth, gross domestic product, GDP, growth rates indicate the overall health of the economy. Strong growth typically supports positive market performance. Inflation rates, monitor inflation rates as high inflation can erode purchasing power and impact investment returns. Employment data, employment statistics, including unemployment rates and job creation numbers, provide insights into economic strength and consumer spending. Interest rates and monetary policy, central bank policies. Central banks' decisions on interest rates and monetary policy can significantly influence market trends. Lower interest rates generally stimulate economic activity and can boost market performance. Policy statements. Pay attention to central bank statements and meeting minutes for clues on future policy changes and their potential impact on markets. Evaluating sector performance. Sector rotation, economic cycles. Different sectors perform better at various stages of the economic cycle. For example, consumer staples often do well during economic downturns, while technology may outperform during economic expansions. Sector analysis. Analyze sector performance to identify which sectors are likely to benefit from current economic conditions. Invest in sectors that align with prevailing market trends. Sector-specific trends, technology trends. Monitor technological advancements and innovations that may drive growth in technology-related sectors. Energy and commodities. Track trends in energy prices and commodity markets, as they can impact related sectors and overall market performance. Adapting investment strategies. Adjusting asset allocation, trend-based allocation. Adjust asset allocation based on identified market trends. For example, increase exposure to growth stocks during an uptrend or shift to defensive assets during a downtrend. Dynamic rebalancing. Regularly rebalance the portfolio to maintain alignment with changing market conditions and trends. Strategic positioning, opportunistic investments, look for investment opportunities that align with current market trends. For instance, invest in emerging technologies or industries poised for growth. Risk management, implement risk management strategies to protect against potential losses during volatile periods. Use stop-loss orders and diversify investments to mitigate risks. Staying informed and flexible continuous monitoring, market news, stay updated with market news and financial reports to keep track of evolving trends and economic conditions. Analyst opinions, consider insights from financial analysts and experts to gain a broader perspective on market trends and potential investment opportunities. Adapting to change, flexibility, be prepared to adapt investment strategies as market trends and economic conditions change. Flexibility allows you to capitalize on emerging opportunities and navigate potential risks effectively. Review and adjust. Regularly review investment strategies and portfolio performance to ensure alignment with market trends and investment goals. Balancing short-term gains with long-term goals. Successfully balancing short-term gains with long-term financial goals is key to achieving a well-rounded investment strategy. Here's how to strike the right balance between immediate opportunities and future objectives. Setting clear financial goals. Defining long-term goals, retirement planning, establish retirement savings targets based on your desired lifestyle and retirement age. Consider factors like expected expenses, inflation, and desired retirement income. Major purchases, plan for significant future expenses, such as buying a home, funding education, or starting a business. Set specific savings targets and timelines for these goals. Establishing short-term objectives, emergency fund, build an emergency fund to cover unexpected expenses or financial setbacks. Aim to save 3 to 6 months' worth of living expenses in a liquid, easily accessible account. Short-term investments. Identify short-term investment opportunities that align with your financial needs and risk tolerance. This could include high-yield savings accounts, short-term bonds, or certificates of deposit. Strategizing for short-term gains. Opportunistic investing, market timing, identify and capitalize on market opportunities for short-term gains. This might involve investing in trending stocks, participating in initial public offerings, IPOs, or trading based on technical analysis. Speculative investments. Consider speculative investments with the potential for high returns, such as emerging technologies or cryptocurrencies. However, be mindful of the higher risk involved. Active management, monitoring markets. Stay informed about market trends and news that could impact short-term investment opportunities. Regularly review and adjust your investment strategy based on market conditions. Trading strategies. Employ trading strategies like swing trading or day trading to capitalize on short-term price movements. Ensure these strategies align with your risk tolerance and investment objectives. Aligning with long-term goals. Long-term investment strategies. Diversification. Build a diversified investment portfolio to spread risk across different asset classes and sectors. Diversification helps achieve steady growth over the long term while managing risk. Compound growth. Focus on investments that benefit from compound growth, such as index funds, mutual funds, and dividend-paying stocks. Reinvest earnings to accelerate growth over time. Consistency and discipline. Regular contributions. Make consistent contributions to long-term investment accounts, such as retirement plans or education savings accounts. Automate contributions to stay disciplined and benefit from dollar cost averaging. Patience and persistence. Stay patient and avoid making impulsive decisions based on short-term market fluctuations. Focus on long-term performance and avoid being swayed by temporary market trends. Balancing risks and rewards. Assessing risk tolerance, risk management. Evaluate your risk tolerance and adjust your investment strategy to balance potential rewards with acceptable risk levels. Use risk management techniques to protect against significant losses. Diversification. Diversify investments across various asset classes and sectors to mitigate risk and enhance the potential for balanced returns. Adjusting investment horizon, short-term versus long-term. Align investment choices with your time horizon. For short-term goals, prioritize liquidity and safety. For long-term goals, focus on growth and capital appreciation. Periodic reviews. Regularly review and adjust your portfolio to ensure it remains aligned with both short-term opportunities and long-term objectives. Seeking professional guidance. Consulting financial advisors, personalized strategies. Work with financial advisors to develop personalized strategies that balance short-term gains with long-term goals. Advisors can provide insights and recommendations based on your unique financial situation. Ongoing support. Benefit from ongoing support and guidance to navigate changes in market conditions and adjust strategies as needed. Utilizing financial planning tools. Online tools. Use online financial planning tools and calculators to assess progress towards your goals and evaluate different investment scenarios. Portfolio management software. Employ portfolio management software to track performance, manage investments, and make informed decisions. Don't forget to subscribe to the channel and like the video. Your support helps us bring more valuable content to guide your financial journey.